So in this video, we will look at the sustainable growth rate as well as free cash flows, and also the relation between the sustainable growth rate and the free cash flows. Both of these are important inputs in our valuation process. Typically, as an investor or an analyst, you're interested in determining the value of a company today. And we can then compare the value that we estimate to the current stock price to see whether we believe that this company is going to be a good investment or not. Now, theoretically, the value of a company today depends on what the company is generating for us in the future. And that's what you will see here. So the value of the company today is a function of the projected future payoffs that we get from this company, discounted at the appropriate discount rate. And we will do so over the life of the company. So we will sum the present value of all projected future payoffs. Now, when we look at the payoffs, they can come either all at once. So maybe in 10 years' time, we will receive one big liquidating payment from this company. Or what's more typical, it can be a stream of payments, where, for example, the company is going to pay the same dividend over the next 10 years, or the company is going to pay a growing dividend over the next 10 years, where we will receive €1 next year, and the dividend is going to be increased to €1.05 the year after, and so on. Now, we cannot just stop by summing the projected future payoffs, because we will need to discount them to take into account what is the value of these future payoffs today. And there are two factors that make that a payoff that comes in the future has a value that's less than the amount of this payoff. One being the time value of money, which doesn't incorporate any risk yet. So generally, people prefer consumption today over consumption tomorrow. And if we get a payoff on a company that lies in the future, we need to be compensated for this, because we will get the payoff only next year, so we will need to postpone a portion of our consumption to next year. And that's incorporated in this discount rate, where if we get €1 in the future, this is worth less to us today, because it means that we have to postpone our consumption. And it should also incorporate inflation, because if we postpone consumption for 1 year and prices are rising, we can also buy less with this euro in 1 year time, because products have become more expensive. So this discount rate incorporates both of these. We prefer consumption today instead of consumption in the future. And if we have to postpone consumption, it means that we can buy less with €1 if there is inflation. So one component of the discount rate is this constant risk-free rate for all assets. However, especially when we talk about a dividend from a company, there is risk involved. We can believe that the dividend is going to be €1 next year, but it could very well also be 50 cents or €1.50. So there is risk involved. And generally, people don't like risk, or at a minimum, they want to be compensated for taking on these risks. And that's also incorporated in the discount rate. We have this projected future payoff, but this projected future payoff is not there with certainty. There is risk involved, and it can be higher or lower than what we project it to be. And the compensation for this risk is also included in the discount rate. Or then if we look at the valuation process, we can split this up into two components. So essentially the value of the company today, or at least the way in which we estimate the value of the company today, we can do so by splitting the life of the firm into two periods, one being the forecast horizon and one being the terminal value. So in the forecast horizon, we are going to develop detailed projections of these future payoffs. So we're going to estimate what the payoffs are going to be over this forecast horizon, or for each of the years in this forecast horizon. And usually the forecast horizon is going to be 5 to 10 years long, because for this period we can make some reasonable projections about these future payoffs. Now, generally the assumption is that firms are going to live indefinitely, and of course we cannot make forecasts for the next 2 to 3,000 years. So that's why everything after the forecast horizon will be grouped in this terminal value, where the firm is going to be stable and the firm is going to be in a steady state. And in this steady state, we're going to have a relatively stable continuing payoff. So basically, the terminal value then captures all the value that this firm is generating for us after this forecast horizon. And as said, relative to the forecast horizon, the firm is in a stable, steady state where, for example, the dividend is going to grow at a constant rate. So one of the key decisions then that you have to make is the length of the forecast horizon and the point in time at which you're going to calculate the terminal value. As said before, in order to be able to calculate a terminal value, the firm has to be in a steady state. And a steady state implies that a lot of factors are going to be stable. And that's what you can see here, because a steady state implies that the return on assets, for example, will be constant, but also that the reinvestment rates or the dividend payouts are going to be stable. And also on whatever we're going to reinvest, we're going to earn the same stable return on investment. So a lot of the factors that you're going to forecast and a lot of the factors that you're going to forecast differently over the forecast horizon have to be stable in the terminal value window. And as I said, a key decision then is, what is the length of my forecast window? And generally what you try to achieve is that your forecasts are gradually moving towards the stable assumptions that you will have in your terminal value window. So for example, if your terminal value assumption is that the firm has a return on assets of 20% and has a growth rate of 3%, you don't want to forecast a return on assets of 40% and 20% growth in the year prior to your terminal value window. It would be better to have the firm gradually move towards this terminal value assumption, where then maybe you can say that in the year prior to the forecast or in the year prior to the terminal value, the growth would still be maybe 3.5% and return on assets would be 21%. And then the firm moves to the 20 and 3% in the terminal value window. But as I said, a lot of factors are expected to be constant. So you will also have to carefully consider then whether what you are forecasting is actually sustainable given the situation of this firm. So given the competition of this firm, given the market in which this firm is active, and so on. Because it's unlikely that, let's say, 30% return on assets assumption is going to be a steady state assumption if there is heavy competition. Because this return on assets would likely be too high and would likely be not sustainable, which cannot be, because everything should be sustainable in your terminal value window. I already mentioned dividends a couple of times, and one way in which we can actually determine the value of a share or a value of the firm's equity is by looking at the future dividends that we're going to get. So in the situation that you will see here, we can use the dividend discount model to determine the value of the firm or the value of the firm's equity today, where we say that the equity value today is basically the present value of all the future dividends that we're going to receive from this company. Where in the example here, we would have a 3-year forecast window and we would start the terminal value beyond year 3. Now, if you look at the dividend discount model, basically what we're saying is that any cash that's distributed to shareholders increases equity value. Because the more we distribute, the higher the dividend, so the higher the equity value. So there is an issue with this dividend discount model, and that's what you see here on the slide. And that's the fact that most companies actually don't pay out any dividends. What you see here on the slide is the number of firm years and the dividend payout ratio that we see for a given number of firm years. And you will see this huge peak at a dividend payout ratio of 0%. So there are many more firms that do not pay out any dividends than we see here in terms of firms that actually pay out a dividend. Which is a problem, of course, if we want to apply the dividend discount model, because how are we going to apply this dividend discount model to firms that are not paying out any dividend? And not only is this problematic for firms that do not pay out any dividends now, but it also makes the terminal value estimation really hard, because we would have to assume that at some point the firm is going to pay out a dividend. And it would require us to estimate not only the year in which they are going to pay out dividends, but also what the dividend then is going to be and what the growth rate of this dividend is going to be. Now, of course, there is also a reason why firms are not paying out any dividends, because they believe they can profitably reinvest those dividends in order to generate even more cash in future years. So in that sense, focusing on dividends is also not really consistent with how we believe that companies add value. Companies can add value by reinvesting dividends and by generating cash flows on these reinvestments. So in that sense, looking at a dividend and saying that if dividends increase, we will increase equity value, that's not really consistent with the fact that we want companies to reinvest profits into these positive NPV projects. Which is why we can turn to another valuation model, and that's the free cash flow valuation model. Where in the free cash flow valuation model, we will determine the value of the firm as the present value of the expected future cash flows, future free cash flows that the company is going to generate. And compared to the dividend discount model that focuses on cash that's paid out, the free cash flow valuation model incorporates these reinvestments and focuses instead on the cash that's generated by the firm as a driver of equity value. However, it's closely related to the dividend discount model, and that's what you can see as well if we start to decompose the components of free cash flow to equity, where typically the change in book value comes from either net profits or dividends. So the book value at the beginning of the year plus the net profit that we generate minus the dividends that we pay out will be the book value at the end of the year, assuming that we don't issue any new shares. So any profit that's not reinvested goes to retained earnings. Retained earnings is part of equity, so that determines the change in equity value. Alternatively, we can also say that the book value of equity changes as a function of the book value of assets and the book value of debt. So the book value of equity at the beginning of the year, we add to that the change in assets, and we subtract from that the change in assets that's not financed with equity, but that's financed with debt. And interestingly, this decomposition actually closely relates to the free cash flow of the firm. Because net profit minus our investment in assets plus the portion of this asset investment that is financed by debt holders gives us the amount that is available for shareholders. So this gives us the free cash flow to equity. So basically what we can say is that the net profit minus the change in equity on our balance sheet gives us an estimate of the free cash flow to equity. And if we take this back to the dividend discount model, what determines a change in the book value of equity? Well, that's the reinvestment. Any net profit that we don't pay out as a dividend increases the book value of our equity and captures this reinvestment. So we can basically say that the net profit that we generate minus the portion that we reinvest into the firm is available as a free cash flow to our shareholders, which is the same as saying that the dividend is equal to the free cash flow to equity, because the dividend captures the portion of the net profit that we don't reinvest. So you will see that these two are really closely related. The net profit minus the reinvestment is our dividend in the dividend discount model, but it's also the free cash flow to equity in our free cash flow valuation model. And instead of maybe looking at this more abstract change in the book value of assets, we can also tie this back to what we've done earlier, and we can look at the individual components in which we can invest. We've seen it with the Dupont analysis and the return on equity decomposition. We can make several different investments. And we can invest in working capital, that's more or less the short-term current asset investments. We can invest in non-current assets like machines, and we can invest in investment assets. So, and that's what you will see here. We've decomposed the change in the book value of assets into these three components in which we will typically invest. So if we look at how much money is available to our shareholders, we can start with net profit. We deduct from that any increase in our net working capital. If we buy additional inventory, this money is not available anymore to be paid out to shareholders. So that's why we subtract any increase in our net working capital. And the same is true for the increase in net non-current assets. If we buy new machines, this money is not available to be paid out to shareholders, so that reduces the free cash flow to equity. And the same is true for a change in investment assets. If we buy some short-term stock investments, this money is not available to be paid out to shareholders. So those three components are the same as this change in book value of assets on the previous slide. And they basically capture how much money we are investing into this firm. Now, of course, from a shareholder perspective, we have to take into account that a portion of these investments are not paid by us. The firm can invest in net working capital, the firm can invest in non-current assets and investment assets, but the extent to which this reduces the payout to us also depends on how much of this is financed not by us, but by debt holders. And that's why we add back the change in debt. So if we finance a portion of these investments by issuing new loans, this increases the amount that's available to be paid out to us. So the free cash flow to equity then is a function of our net profit minus the change in our investments plus the change in debt, because that captures the portion of these investments that are not financed by us, but that are financed by debt holders. And if we say that debt to asset levels are stable, we can sort of simplify that and immediately only subtract the portion of these investments that are financed by us. And that's what you will see in the second way to calculate free cash flow to equity, where we start from net profit and we deduct these three investments, but only for the portion of equity in our capital structure, because that will be the amount or the percentage that we will finance as a shareholder, and that will capture the portion that's not available to be paid out to us. And just as we can calculate the free cash flow to the shareholders, we can also calculate the free cash flow to the firm. And basically that will be the free cash flow to debt holders as well as shareholders. And given that we're now looking at the free cash flow to debt holders and shareholders, we don't see this debt adjustment anymore. If we calculate free cash flow to the firm, debt levels are actually irrelevant, because we're interested in how much we can pay out to both debt holders and shareholders. So we're not so much interested into whether we have 40% of debt and 60% of equity versus 50% of debt and 50% of equity. So in order to calculate the free cash flow to the firm, we again start with net profit. But if we look at how much is available to be paid out to debt holders and shareholders, we would need to add back the after-tax interest expense, because this is not so much an outflow and this is not so much an amount that's not available to be paid out. This is actually something that we will pay out to debt holders. So instead of starting with net profit, we start with net profit plus the after-tax interest expense. And we then subtract those three investments. And that will tell you the free cash flow to the firm, and that will tell you how much can be paid out to debt holders as well as shareholders. Now, this is what we get if we calculate free cash flows directly. We can also calculate free cash flows to the firm by going from the free cash flow to equity. Where in this case, we don't start with net profit. The starting point of our calculation would be the free cash flow to equity. As before, we would need to add back the after-tax interest expense, because this is not an expense and this is not an outflow from a free cash flow to the firm perspective. So we would need to add back the after-tax interest expense. However, we would also need to deduct the change in debt, because the change in debt increased our free cash flow to equity, but it should not affect the free cash flow to the firm, because that actually captures how much can be paid out to debt and equity. So this increase in free cash flow to equity that we saw because of issuing debt, we don't want to see this effect in our free cash flow to the firm calculation. So basically, we can calculate a free cash flow to the firm by adjusting for everything that involved debt levels. So we add back the after-tax interest expense, because from a free cash flow to the firm perspective, this is no longer an expense. And we subtract again the change in debt, because that doesn't increase the free cash flow to the firm, because that actually captures how much can be paid out to debt holders and shareholders. Now, as said before, these free cash flows are closely related to dividends, and they are closely related to reinvestments, because any portion of net profit that's not paid out as a dividend but that's reinvested reduces our free cash flow. And you also can see the strong relation with the sustainable growth rate. So the sustainable growth rate essentially tells you the expected growth rate of this firm if the firm is going to maintain the same profitability and if the firm is going to maintain the same financial policies. And it provides a good benchmark for developing forecasting or valuation models. And it basically says that we can grow at a higher rate if we are more profitable, because if we are more profitable, we generate more money, so we can also reinvest more money. But then it of course also depends on how much money we actually reinvest. And that's this times 1 minus our dividend payout ratio. Because we can grow faster if we pay out less of our earnings as a dividend, and if we reinvest a bigger portion of these earnings back into the firm. And that's exactly what this sustainable growth rate tells you. How much can be our earnings growth if we have a certain level of profitability and if we have a certain dividend payout or a certain reinvestment rate. Which I said is closely related to free cash flows, because whatever we reinvest is not available for shareholders or debt holders anymore, and thus reduces our free cash flows. So we can actually calculate free cash flows directly then by looking at the reinvestment rate that we also see in the sustainable growth rate formula. Because the reinvestment rate actually captures our net investments in net working capital, net non-current assets, investment assets, and the portion that we don't finance ourselves if we issue additional debt. So when we looked at free cash flows, we subtracted those three investments and we added back the change in debt. But this will actually be exactly the same as looking at the equity reinvestment rate. And if we don't incorporate debt, we can actually see that the capital reinvestment rate is equal to our investments in those three asset groups. So the two are really closely related. The adjustments that we make to net profit to go to the free cash flow are equal to these reinvestment rates times the net profit in case of free cash flow to equity and times net profit plus after-tax interest expense in case of free cash flow to the firm. Now let's look at two examples, and the first one is most closely related to the traditional sustainable earnings growth formula, where we say that we have an ROE of 30% and we reinvest 40% of our profits back into this firm. If we look at the sustainable growth rate formula, that would tell us that next year we can grow our earnings with 12%. Given the current profitability and given how much we reinvest of this, we can grow our earnings next year by 12%. So if we reinvest 40% and we earn 30% on any new investments, we can grow our earnings with 12%. However, we can also slightly change our sustainable growth rate formula to accommodate changes in ROE. And that's what you see in the second example, where we say that ROE next year is not going to be 30%, but it's going to be 33%. Other than that, the assumptions remain the same. Now, what it means is that we will now have two sources of earnings growth. And one is the same as before. We have reinvestments, so we reinvest 40%, but in this case, these reinvestments are earning us 33%. And that's the second part that you will see in the example here. When we determine our earnings growth, we have to take into account the growth that we get by reinvesting. And that's in this case 0.4, the 40% reinvestment, times the 0.33, which is going to be the ROE that we're going to earn on those new investments. However, if we say that ROE is going to change, we can also assume sometimes that it's going to change for our existing investments. And that's this second source of earnings growth that you will see here, where the ROE is going to go from 30% to 33%. And divided by the 0.30, that will tell us the growth that we have because of having a changing ROE on our existing asset base. So in this case, if ROE is going to change, we have two sources of earnings growth. The reinvestments that we're going to make that are going to earn this ROE, but also the existing assets, which now have an ROE of 33% instead of an ROE of 30%. And you will see then that with this assumption, earnings growth is no longer 12%, but is actually increasing to 23.2%. And a big portion of that comes from not only this reinvestment, but it comes from having existing assets that are going to be more profitable because they now generate 33% instead of 30%. Now let's look at a final example where we have firm A, and firm A has a net profit of 1,000, an after-tax interest expense of 100, and we want to calculate the free cash flow to equity and the free cash flow to the firm under the following assumptions, being an equity reinvestment rate of 40%, a capital reinvestment rate of 60%. And based on this information then, we also have to calculate the debt that's issued by the firm. Now let's start with the first question. what's the free cash flow to equity if we assume that the equity reinvestment rate is equal to 40%? And as said before, the equity reinvestment rate captures these net investments in working capital, non-current assets, and investment assets, adjusted for changes in debt. And we can use the equity reinvestment rate to directly calculate free cash flows. So net profit is 1,000, and we subtract from that the portion of net profit that's reinvested, 40%, which leaves 600 available to be paid out to shareholders. So in this situation, the free cash flow to equity is 600. Now the second question asks for the free cash flow to the firm, assuming that the capital reinvestment rate is equal to 60%. The capital reinvestment rate and the free cash flow to the firm don't depend on net profit, but they depend on net profit plus after-tax interest expense. So that's the first part of the solution where we calculate EBIT. So we have 1,000 in net profit, but we need to add back the after-tax interest expense. So earnings before interest and tax are 1,100. Now the 1,100 becomes the starting point for the free cash flow to the firm calculation, where we subtract now 60% of the 1,100 because the 60% was our capital reinvestment rate. And that will give us a free cash flow to the firm of 440. And then we also have enough information to calculate the debt that's issued by the firm. Because now we know from the second question that the investments in working capital, non-current assets, and investment assets are equal to 660. And then we have enough information to be plugged into our free cash flow to equity calculation. Because the free cash flow to equity was 600, the net profit was 1,000. If we subtract from that the investments in working capital, non-current assets, and investment assets, plus the debt issued, should give us this 600. And the number that will make this equation work is 260. And then we've plugged in everything into this free cash flow to equity formula. We start with the net profit of 1,000. We subtract from that 660. Those are the investments in working capital, non-current assets, and investment assets. Plus 260 of debt issued brings us at this free cash flow to equity of 600. And as I said, we can also go directly from the free cash flow to the firm, where we adjust for these two items that relate to debt. So we can also start from the free cash flow to the firm, which is 440, deducting 100, because that was the after-tax interest expense, plus the change in debt. And that should also bring us to the 600 free cash flow to equity. And there you will also see again that the change in debt should be 260, and the firm has issued 260 in debt.